Good morning, everybody. Thank you for joining us. Thank you for joining another class for the Small Business Education Program. My name is Juan Salas. I'm one of the instructors here at Extension, and today we're going to be talking about closing your books in your business. So, before we begin with the presentation, I just want to share something with you. It is Christmas, so we are all about sharing at this time. So this is the nice website with a lot of information, good tools about small business information. Just jumping into the website for the Department of Business and Industry, and you're gonna find a lot of resources, which most of them are for free. You can browse and learn more about the business environment and the roadmap. But today we're gonna be talking about closing your books. We're going to just start a little bit of review of what happened in 2021 and how is this important for your story, for your financial story. Then we're going to be talking about the accounting cycle, and the accounting cycle at the end, we have the closing the books process, and a little bit about tax planning for tax season. And of course, an action plan that you can apply and get this information into action as soon as possible. We have some time for questions and answers as well, but let's get started. So 2021, it's ending, but it has some challenges. It was a very interesting year. I don't know if it was more interesting than 2020 or 21, but I think from the tax and accounting perspective, it kind of merged 20 and 2021, believe me. So a lot of businesses had challenges, but a lot of businesses had new opportunities as well. You know, depending on your industry, depending on your situation. We had the experience of talking with the small businesses that actually it was pretty good year on 2020 and 2021. If you were on the gym industry, exercise industry, for example, there were some restaurants that were able to pivot during the pandemic, and they had a very good year in sales. Others did not. So you have to re-evaluate what happened in 2021. There was a lot of government assistance. You know, local agencies were giving grants, loans. Some of the loans were forgivable, others not. There were a lot of, tax credits going on. From the IRS side, we got the employee retention credits. So there was a lot of components from the financial perspective this year. So you have to think about what or how these events are recorded in your business, okay? Just keep that in mind. So, because your financial records, the accounting that we're gonna talk about before we close the year, is gonna tell a story. And you have to control that story. You have to know what is the story behind your financials, what is gonna be represented as your situation from the financial perspective. We talked with a lot of bankers and small business owners, and they told us, the adequate records, organization, and taxes were more relevant for small businesses than ever before. Organization, record keeping, taxes, and accounting became a really big part of the operation and how to pivot through the pandemic. Okay. So if you agree with me, say yes or no, or what do you think? We welcome your comments. But this is something that we should talk more about, and we have a lot of classes. So this is kind of an overall perspective of 2021. See how your story fits on that recapitulation of the 2021. Because we're gonna do the accounting cycle. Before we close your books, which is the step 5, we want to make sure that you go through the accounting cycle, because that's the end result of the accounting cycle, closing your books. And the accounting cycle it captures all transactions and events throughout the year. The mission behind this cycle is to orderly process and create accurate and reliable financial statements. We have a process which should be, which has an order, like any other process has steps, with the mission of creating accurate and reliable financial statements. Okay, so the accuracy, it has to reflect what happened in this 2021 in your business. So let's start with step number 1. Capture all the transactions in your business. The question is, where do you find these transactions? Okay, 2021 was kind of hectic. There were a lot of things going on, new technology, new processes in your business. Maybe you have to hire new employees, fire new employees. So where do you find all these transactions? Is it all in the bank statements? Do you have credit cards? Do you have a checkbook where you can actually recall who got that check, or all the checks were cash or not? Are there any expenses on your personal accounts? Those have to be included as well. At the time, we were in a hurry. We just used the credit card that we found in our wallets, or the ones that we were at the desk, so we can do some online purchasing. So we have to track all those transactions. Where are all those transactions? And in the process, of course, make sure you have the documentation, because if you get asked about these transactions, you have to prove that are necessary and ordinary for your business. Income. There were a lot of new methods, technology. People started getting payments through Zelle, through PayPal, some cash. Sometimes the cash didn't make it to the bank because you had other emergencies. So make sure you know where to look for those transactions. So if it's everything in one place, that's perfect. But things happen. Emergencies happen, unpredictable events. So make sure you know where to find all these transactions. The second step is classify the transactions. And we have to do it in an orderly way. There's a method, there's a process. So everything has to go into categories that are listed on your, I call it your menu of accounts, which is your chart of accounts. It's where you put all the reasons that you spend money for and you got money from. Because every transaction has to have its own category. So evaluate how many categories do you have? And if you need all of those categories. For example, if you go and do a report or your profit and loss right now, you go into your bookkeeping software, or you go into your bookkeeping method, Excel spreadsheet also, and you do a profit and loss. Is it going to be like 2 or 3 pages? So maybe you have too many categories. Maybe you need to create some subcategories that are going to consolidate the profit and loss and is easier to read. Remember, the profit and loss, it is a list of your activities that end up hopefully in a net profit. So if you're going to show this to a banker, if you're going to use it to analyze, let's make it easy to read. Okay, let's not make it 2 or 3 pages. Maybe you need to cut down on your categories, analyze your chart of accounts, and try to figure out what do you need, what can you organize better so it's more readable and you can analyze it faster. Okay, subcategories are very important. I always believe you have to go through details. If you're going to have office expenses, you should know how much goes into coffee, how much goes into the internal consumption and the external consumption for your clients. If you have supplies, what kind of supplies? Is it paper? Is it ink? Is it, trash bags? Is it furniture sometimes? like office expense. So it's nice to have, but don't make it so extensive that it becomes hard to read for investors, for bankers, and things like that. Detail is good, but make sure you present it in a nice and orderly way. This is a little kind of an example. All the transactions have to go into categories, right? Just we covered this in another bookkeeping class, but all the transactions have to go into categories, and these categories are going to belong to the main type of accounts, which are assets, liabilities, equity, income, and expenses. So every category is going to belong to one of these ones, only one. That way you can organize things. Everything falls within the only five type of accounts. Okay. So these categories you can play with. The type of accounts, they are set. Those are accounting rules. You cannot change those. Okay. So organizing happens on the category side. And then to pull or organize the reports, we use the type of accounts already established on the accounting system. So that's part of the accounting cycle. We organize those transactions so we can use them later on. I don't know if you knew about this guy. This is Luca Pacioli. My Italian is not that good. See, he's the father of double entry accounting. The double entry accounting has been around since 1494. So this is a system that we have been using for a while. Okay. And basically he said, you know, every financial transaction has an equal and opposite effect in at least two different accounts. And it is used to satisfy the accounting equation. What is the accounting equation? The accounting equation is assets equals liability plus owner's equity. This is what the rule that rules the accounting world. Okay, this is how we don't lose money and we catch up the bad guys when they are doing things that they shouldn't do, and auditors depend on this equation to find out about irregularities and things like that. So this guy is responsible for this, and we have been using this method of double entry accounting for a while. So it's about time we learn about it. So all transactions are recorded in debits and credits. Why? We have debits and credits because remember, Luca said we have two effects on every single transaction, a debit and a credit. So since a debit in one account offsets a credit in another, the sum of all the debits must be equal the sum of all the credits. This is a little bit technical, but it is important that you understand the general idea of what's going on with the double entry accounting. So this main equation, assets equals liabilities plus owner's equity, it remains balanced, it remains true because all the debits must be equal to the sum of all the credits. Okay, so just to make it more simple, I think so. Let me know if it's no more simple, but if we expand it a little bit more, because owner's equity, it has other components in it. Owner's equity can mean many things, a few things, not many. So if we expand this formula more, is assets equals liabilities plus accumulated earnings plus income and expenses. So the owner's equity, I'm going to give you a minute to think about this. Owner's equity, it is also the sum of accumulated earnings, which is what? It's your profits from previous periods, from previous accounting periods, accumulated earnings. We are accumulating profits and losses throughout time, right? We are talking about an accounting cycle for 2021. In this accumulated earnings, we have the result of the accounting cycle for 2020 and 2019 and 2018, if your company was, in operation. So on the accumulated earnings, there's the history of past accounting cycles. Okay, and now the income and expenses side is basically what is happening right now in this accounting cycle. So far, if I'm making money, if my income is more than my expenses, yes, I'm making money and my owner's equity are going to be bigger. Okay. If I'm losing money, it's going to decrease. But my accumulated earnings is not going to change. That's on the past. We already closed the books for that accounting cycle. So hopefully the breakdown of this equation in a simpler way for me is also simpler for you, easier for you. Please say me yes, or hopefully we can answer more questions about this. If it makes sense, let me know, and I'll be happy to answer more questions about this. Yes, intuition, try to think about time periods. Thank you for your comment. So let's move on. We are going through the accounting cycle. Just to give you a little example, if there's a balance in your bank account of 1,500, where did it came from? Nobody, it just shows up, okay? So if your balance, if you have an asset, a balance of 1,500, maybe it was a loan that you got, a liability, and maybe it was an owner contribution of 500. Okay, so that's how the equation remains equal, balance. If the money is in the bank, we have to specify where it came from. Okay, it was a loan plus the owner contribution in this example. So the third component of the accounting cycle is to create a trial balance. A trial balance report is not very well known, out there. It is not a profit and loss. It is not a balance sheet. It is not a cash report. It's a trial balance report, which is used usually for an internal audit, that it shows all the debits and all the credits. If you see in this example, you got all the debits and all the credits. And remember what Luca said? It said that all the debits should be equal to all the credits if we are doing things right. So the trial balance is going to allow us to catch any errors, because if, for example, we have an amount in the cash account that is on the credit side, maybe we should look into this, because we shouldn't have a negative balance if I only have one bank account, right? Then we have, for example, office expenses. We should, let me 1 second. Sorry. Okay, so this is going to help us to catch any errors or anything like that. Let me go back soon. So in this trial balance, you're going to see that we are listing all the type of accounts. Okay, all the type of accounts that are assets, liabilities, equity, income, and expenses. So it is very practical because we can visualize everything. We can visualize all the returns. So what happens here is you revise this report, you make sure that all the credits and all the debits add up, and then you can move on to the next step. The next step is to review and correct all transactions. For example, we were talking about 2021 being a different year. So over here, what happened is you have to check all the bank accounts. If your bank account balance drive with your reports, what about your balances with credit cards? If you have a balance outstanding with a credit card, it should be reported in accounts payable because you owe them money. If you have any personal expenses or paid any personal expenses through the business, it should be reflected on your owner's equity. You took money for yourself from your business. If you have other sources of income, for example, if you have a PayPal account, that should be reported as an asset as well, because that's money that belongs to your business and you have control over it. So it should be listed as an asset as well. So income sources like Zelle and PayPal, they should be included. And there are new regulations that are coming forward that is gonna increase the communication between those vendors and the government. And of course, check if you have adequate documentation to do this, okay? We have a quick question. If I work a part-time wage job while I was doing my business this year, what would account as an asset? Your wages are part of your personal earnings, are not going to be reflected on in your business account. So your business is only what belongs to the business. If you have an LLC, for example, what are the accounts, what are the assets for that particular LLC? Sometimes when you run your own business, things get a little bit confused, but it shouldn't. Just keep things separate from your business. Open a business account. If you don't have an LLC, still, you can open a business account and keep things separate. Very well. Now, after running this, you can see on the trial balance all your expenses, all your income, your assets, and liabilities. And this is where it gets a little bit tricky, okay? But follow me. So when you close your books, we have to find out. Let me open up a spreadsheet. Give me 1 second here. When you close your books, you have to realize that in the accounting world, we have 2 sets of accounts. We have temporary accounts and we have permanent accounts. When we close your books, what we do is we have to close all the temporary accounts. So when we close the books, we are basically closing all the transactions, saying that this is the final version of our transactions and we're not going to make any more changes. So we are moving from one accounting cycle to a new accounting cycle. And to move to a new accounting cycle, we have to close what we call temporary accounts, okay? So the temporary accounts are temporary for that particular cycle. And the permanent accounts are permanent throughout the life of the company. So the purpose of the temporary accounts is to use them only through one accounting cycle. Then we zero them out. And to zero them out, we have to move the information into the permanent accounts because we're closing the books. We're gonna make these reports permanent on our records, on our company financials. So the process of closing your books ensures that everything stays the way you want it. And it also prevents any accidental changes that could affect your financial reports. So that's kind of the whole purpose before for the closing of the books. We're putting an end. We're saying this is going to be set on stone from now on. Yes, we can make changes, but we shouldn't. So it's going to be part of the permanent history of our books. And also, it helps you reset these temporary accounts so you can start a new accounting cycle and do more reports and things like that. Let me see one chat here. Oh, thank you. So hopefully that can that paints a picture in your mind about the whole accounting process and why we do it. Because I was asking, you know, some other accountants, how do you explain the process of closing your books? You know, do business owners actually understand why we do this? You know, what is the relevance? It's like, I'm closing my books. It's like, okay, are you just closing your books? Are you pressing save? Are you creating reports? Yes, we are creating reports. We are creating final reports, which are going to be used to do your taxes, and is going to be part of your permanent financial records. And nobody can go ahead and touch the information. You know, if you have one employee that goes back and changes the income, for example, the income and amounts, and then he steals the money or creates more expenses and things like that. That's why you lock down your books, basically. And that becomes part of the tax return, for example. Imagine if you go back and change your books, and then your tax return doesn't drive with your accounting books anymore. And if you get audited, it's like, okay, I thought that I saw that back then when I did my taxes, but now that I see it, it has changed, it moved, I don't remember. That becomes an issue, believe me. So that's why you basically lock down on to do that. So locking the books, when to do this? Most of the accountants, I mean, to properly close your books, it usually happens at the end, by the end of January. Because if you think about it, if you write a check on Christmas, but it goes to the mail and it goes to the recipient, and they are on vacation, they don't catch the check and things like that. So you have some pending transactions that belong to 2021, but we are in 2022 and it hasn't happened yet. If you made the check on 2021, it belongs as an expense for 2021. Okay, so because the money you don't have on a cash basis, you don't have the possession of that money anymore. You pass on the rights of that money to somebody else. If they catch the check or not, you know, that's a different story, but they have possession of that money technically because of the check. So We have some payroll things. We have some sales tax reports. So usually it happens, you can have all the information ready and reliable and accurate by late January. Yes, that's a great question. So closing the books, it really doesn't happen on December 31st. It's your accounting period ends on December 31st. But the actual process of closing your books, you know, it is a process. So yes, it is okay to start closing your books in January for the accounting cycle for 2021. You know, your accountant is not late. It's just going through the process of doing so. So don't get mad with your accountant for that. Let me just, I just realized one of my spreadsheets right here might not be accurate. So let me go this. So I have an example in here in the presentation, but I want to use an Excel spreadsheet. So can you just tell me that if you see my spreadsheet, I'm going to make it big. Thank you. This is your trial balance, right? Right here. And we have separated it on permanent accounts and temporary accounts. The temporary accounts are income and expenses. Okay, very similar to a profit and loss. We always make sure that we are adding all your debits and credits, right? Okay, so you see all our debits and our credits are always the same. 60,700, 60,700. But like I mentioned, we have to close our books. So what we are gonna do is make these accounts zero. We have to zero them out, okay? And what happens if we only look at these accounts, the temporary accounts, we see that income, salary, the expenses, at the end, we have a net profit of 4,600. It is very similar to our profit and loss statement. The temporary accounts only include income and expenses. And if we isolate them, it's going to show that we have 4,600. This is not equal because we're not taking all the debits and all the credits into consideration here. We're only taking the debits and credits for the temporary accounts. Okay, this is just one part of the trial balance. It's not the complete trial balance. So in order to close these accounts, the net profit, we are going to move it to a permanent account. And guess which one? Net profit is something that belongs to the owner. So we're going to move it to the equity account. The net profit belongs to the owner. So when we close the temporary accounts, we are going to move it to the equity account. So when we move the profits, what happens? If we zero this out, you see that income is zero, expenses are zero. We add up the net profit of 4,600 to the already 50,000. which add up to 54,600. And that way, mathematically, the debits and the credits are the same. So the whole process of accounting cycle ends up through the closing of the books. The closing of the books means that we are gonna get rid of the temporary accounts because we're gonna make a permanent record of the transactions. In order to do this, we looked at the temporary accounts, we isolate them, income and expenses. We see what's the difference, which is the profit. It can be a negative number as well. And we add it up to another permanent account, which is, in this case, the owner's equity. So now we got rid of all the temporary accounts. We have only permanent accounts, and we have closed the accounting cycle. That's the meaning of basically closing the books. We make everything permanent. Okay. Yes, it click. You see a light or no? Let me know if you have any questions. Okay. This is kind of the high point of the presentation. So let me know if you have any questions at this moment, and if it clicks or it didn't click, it is very important to me to know that that you understood and you can picture the process, the reason, the why of we do this. Okay, perfect. Thank you. Thank you. So once we have closed the books, we have made everything permanent. Now we can create the different final reports. You know, the balance sheet, the income statement, and the cash flow. I have a brief description about the definition of each of them, but we have touched this in other classes as well. But these are the final, the after closing the books report, the balance sheet, income statement, and cash flow. This is the information that we're going to use to prepare taxes and make things permanent. Can you run balance sheet, income statements, and cash flows reports before closing the books? Yes, of course you can throughout the year. Actually, the closing of the books should be done monthly. So, for example, if you close your books already for January, February, March, and April, you can work on May at ease, because you know that the other months are already closed, are already locked. Nobody's gonna touch anything. So you have to worry only about that particular month. And if you create a balance sheet, an income statement, and a cash flow, you should create it only for the months, or include the months that are under lockdown, you know, are already permanent. So they are reliable reports. Okay, you are not changing things a month after, or changing things on the month of January, where you already have created a full report for half of the year. Okay, it beats the purpose. So balance sheet, income statements, and cash, those are the main reports, financial reports. Each one has its own use and limitations. So always use the three of them to make decisions, and investors and bankers are gonna ask for all three for loans and applications and for your own operating decision making. So once you have already your financial reports done, close, final reports, or at least now you can create financial reports for the information that you have on hand, you can estimate and plan for your taxes. For example, if you have a sole proprietorship, you know that you're going to pay 15.3% on the net profit. That's going to tell you on your profit and loss statement, plus your federal income taxes. If you have an S corporation, you know that whatever it is left on as a net profit is going to flow through your K1 and you're going to pay taxes on it. You're going to pay federal income taxes on that. If you have a partnership, it's kind of similar. You know that the profits on your partnership are going to get distributed and the owners are going to pay FICA taxes, which is for 15.3%, plus federal income taxes on the net profit. So once you have your income statements, in the case of the corporation, it's very straightforward. It's 21% of the net profits. So once you have your financial reports, you should already know which tax structure applies to your business. That's in another class. But with that information, you say, okay, yes, I am a sole proprietorship, so I can estimate my taxes that are going to be 15.3% of my net profit. So with that information, you start making and taking decisions. Am I going to invest on capital? Am I going to invest on new equipment? No, I want to keep the money. I want to keep it on the bank because I want to save for the next year. I don't know how sales are going to go. So I better pay the taxes and keep the money for emergency purposes. With that information, you are not going blind into tax season. You are not going with expectation of surprises, what's going to come down after tax season. So use this information to catch up, to plan for whatever is going to happen in tax season. Yes, you can plan now. Your business is one thing, but you have to figure out how your business is going to affect you as well on the personal side. So how are you getting paid from your business? If you are a sole proprietorship, I'm pretty sure you were taking draws from your business. But for example, if your net profit was 50,000, but only you took draws of 40,000, you're going to pay taxes on the 50,000. Okay, because you paid self-employment taxes on the net profit on a sole proprietorship. So use this information based on your accounting cycle, plan for taxes. If you have an S corp, I'm pretty sure you already did a W-2 for reasonable compensation. That's going to affect you as a personal side, and also take in consideration what is left over of the S corp, because you're going to pay taxes as well. Or maybe there's a loss, so you can make sure it's not going to be a surprise. Partnerships, those are very interesting because at the end of the year, the partner's like, I didn't get any money, but I have to pay taxes on it. Yes, you do, because you belong to the partnership and the net profits are going to get taxed on your personal side, whatever you took the money or not. So it shouldn't be a surprise. The rules are out there. So it's not news for, it shouldn't be news for anybody. Let's put it that way. Corporations, you can only take money out of the corporation by doing a W-2, dividends, and return on capital. So before the end of the year, we are almost at the end of the year, plan how you're going to take that money out, or how that money is going to flow from your business to your side. If you go through the accounting cycle, you have the information. So action plan. What's going to be, what are you going to do with all this information? Are you going to be busy this weekend going through your accounting cycle? Are you planning to call your bookkeeper, your accountant, later this afternoon? Because you might want to run some numbers. Let me know your thoughts. But here's some action plans, some action points right here. Do a little bit of housekeeping for your business. If you haven't created invoices, if you haven't billed people, send them reminders. Make sure that all the unbilled activity is accounted for, because we're closing the books. Is not we're forgetting about the people that owe us money. Okay, so make sure you have that organized. Maybe you can bring more money into the business, make it a stronger financial position. So send those reminders over the weekend. Start billing people before they spend all their money on Christmas. Record all expenses. Please catch up with your expenses. It's that time of the year that we have to go after expenses, not too much of profits from the business perspective. And make sure all the categorization is done correctly. Don't be creative about expenses. If they are personal expenses, let it be. It's personal expenses. Don't try to be too creative or make it a business expense. It has to be necessary and ordinary. You can be creative about Christmas presents, but taxes and accounting, not a good idea. Pay your bills. That didn't sound right, but what I mean is pay your bills to take advantage of discounts. If you can avoid late fees, you can avoid get a discount. If you pay before the end of the year, you're gonna get 10%. Yes, I'll take that 10%. The bank is not paying that much, so take advantage of the discounts for your outstanding bills right now. Save all documentation. Checks. Many small businesses do not request checks or images of the checks for their accounting and final documentation. Yes, I know you can see the checks on your bank account, but it's only for the last 8 months, sometimes 12, okay? But all the audits, all the questioning, whenever you need those copies, it's gonna be like 1 year or 2 years after. So right now, you can request, the image of all the checks and just save them in a flash drive, move it to the cloud, save the documentation electronically. Checks and any other receipts that might get faded with time. Decide on additional compensation, capital investments based on your final reports, financial reports. If you can afford to pay yourself more and it's going to save you taxes, if you can afford to buy new equipment because it's going to break down in the next 2-3 months, we have some logistics issues going on. So plan for it. Do not spend money because it's tax deductible. It has to be productive for your business. I always say it has to make you more money. Don't do it for just making another tax deduction in the business. Plan for upcoming tax liabilities for payroll and sales taxes. Even though we're going to end up the year on December, you have to make payroll contributions and sales taxes contributions in January that correspond to 2021. So put money aside for that. And also, if you have inventory, try to do a little housekeeping cleanup. Make sure compare your purchases with whatever you have on hand, because sometimes things are missing. Sometimes employees might take advantage of a situation and take some of the inventory. So make sure that whatever you have on hand is really what you have on hand. You can run reports, meet with your accountant, analyze these 3 main reports so you can compare it with previous years. Pull up your taxes from last year. If you didn't like something on your taxes of last year, this is the final days to make an impact and make those changes so you don't end up in the same situation. Estimate your tax liability for 2021. This is very, very important. If you're a sole proprietorship, if you have an S corporation, if you have a partnership, there's that information that is going to flow from the business tax return to your personal tax return. That's going to make a huge impact. If you sold a property, if you made money and then you didn't have those expenses, that's going to become an income source on your personal taxes. So make those estimated payments now, or at least plan for it, put the money aside, because nobody wants to pay more taxes that they shouldn't, but then we don't plan for those taxes, and then we end up paying late fees, interest, and penalties. So it beats the purpose. I thought you didn't want to spend money or give money to IRS, but the behavior, it's telling you something else. Okay. So at the end, close your books, save all your reports and documents in a secure place and in a secure format that you can actually pull that up later. When you talk about your documents, your financial reports, I know that you trust your bookkeeper, I know you trust your accountant, but keep a copy. Always keep a copy. If something happens, something goes missing, somebody goes missing, you have to have all your records in a secure place and also in a secure format that they don't fade, they don't get wet, they don't get burned. So you can actually use them like 2 years from now if there are any questions and things like that. Okay, so that's your action plan. It's funny that we always do the action plan for Fridays, now that I think about it. So hopefully this weekend you can put some of these steps into action, and we can close the books properly in an orderly fashion. Thank you. Thank you. I'm going to stick around for just some questions. In the meantime, I'm going to invite you to go to our website. This is the website that I'm talking about. Over here, we have our virtual classroom, which has a lot of more videos and classes we have done in the past. And you can browse through subjects. And the podcast is coming soon, hopefully on January, February. And let us know your questions, your comments. If you like it, if you're not, suggestions, you can subscribe to our webpage and let us know what you like. Share the information. I think this information works. We think that is useful. If you agree with us, share that information, share the page, share the knowledge. We can build a better small business community with resilience. No, thank you for everybody attending. I appreciate your comments. Have a wonderful weekend. Thank you for joining us. Again, my name is Juan Salas, instructor with the Small Business Education Program. We'll see you next time on the next class. Thank you.